welcome back here with us on Newsroom on Bloomberg TV India. We have visuals of Christine Lagarde with Governor Raghuram Rajan. Do remember, of course, that this is a two-day visit. She started yesterday. She was in Delhi. She met with the Prime Minister and the Finance Minister. Post that meeting, a pat on the back of sorts coming out for India, where she said India's only bright spot in a weak global economy, and also saying that Governor Rajan doing a lot of things right, and saying that she's quite confident on the growth of the Indian economy. That, of course, is live visuals coming in of that meeting with the RBI governor as well as with the RBI. Christine Lagarde saying the world really looking to India to lead the path to higher sustainable as well as inclusive growth. We're going to cut across to that the minute she starts speaking, but I'm just recapping some comments we've got from her earlier as well, where she's continuing to talk about positivity and the optimism on India and Indian growth. She's saying the flexible inflation targeting to conduct monetary policy is a welcome step, and that India's monetary policy is in good hands. Remember, of course, that Governor Rajan used to be at the IMF between 2003 to 2007, so they share that history in that sense. As far as what we're seeing playing out in the global economy, including, of course, that crucial two-day Fed meeting, which will end tomorrow in the US, and the commentary from there. Christine Lagarde saying that the United States is expected to raise interest rates later this year, and likely to see volatility in financial markets, and that it could pose a potential stability risk. This is as far as the Fed action goes. Also speaking on global growth, Christine Lagarde earlier said that global growth is still fragile and uneven, and that in the entire pack, India still manages to stand out. I think Governor Rajan is going to speak in a moment now. Let's listen.
Great. Thank you very much. Friends, colleagues, Ms. Lagarde, welcome to this interactive session. I don't have any opening remarks myself, so I will go straight to introducing our guest. Ms. Lagarde has a fantastic career. Just mentioning some highlights. She was a member of the international law firm, an employee of the international law firm of Baker and McKinsey. Started as an associate, rose to become the chairman of the Global Executive Committee, and from there moved, after being CEO of the firm, to the French government, where she was the Minister of Foreign Trade and then the Finance Minister of the French government. From there, she went on to the IMF, where she was the first woman and 11th Managing Director, and she took on that post in July 2011, at a time when the world was still struggling to come out of the crisis. Amongst her other accomplishments, she's been a member of the French national team for synchronized swimming, and has also brought up two sons. A lady of great accomplishment. May I present to you Ms. Lagarde.
Well, thank you so much, Governor Rajan, for this kind introduction, for having covered the ground quite extensively, including my sport achievement and maternal accomplishment, which is not the least of my pride. Good afternoon to all of you. I'm ever so pleased to be back to Mumbai, back to India, and to see quite a few very close and long-standing friends in the audience. It is indeed the privilege to share the floor with Governor Rajan, one of the world's most highly regarded financial economists, one whom the fund is fortunate enough, actually, and chief economist, head of the research department for a long period of time, at a period where nobody was really forecasting the crisis and where needed. One acts of the IMF was not to have listened to him enough at that time. But we do now pay attention to anything that Raghu says. And he's been certainly extremely busy since he's taken over as governor of the RBI in September 2013. And he has deftly steered the Indian economy to safer waters after it was hit by the turmoil on the market after this famous tapering tantrum episode of mid-2013 that preceded by only a few months his appointment at the head of the RBI. Now, most recently, he has indeed made the headlines by introducing this flexible inflation targeting as the new regime for conducting monetary policy, a very welcome step, and one that we just learned a little bit more about during the course of the hour that we spent together, and which I found certainly most sophisticated, appropriate, and extremely interesting as an engine, a radar, an indicator, and a very powerful framework against which to describe the monetary policy of India. So I'm very pleased that India's monetary policy rests in excellent hands, with the ability to innovate and to structure and deepen the financial market and to supervise it very ably. So as this is the case, let me just move a little bit away from that and talk about a topic that I know has been an important concern for this central bank as well as for other colleagues in other emerging countries, developing countries, and advanced economies also to a certain point, because all of those are interlinked and certainly very concerned about the monetary policies of each other's and the spillover effects of each other's and the spillbacks to a certain extent. So I'm referring, of course, to something that is called the unconventional monetary policy easing that we are likely to see in some of the advanced economies following the unconventional monetary policy that was adopted right after the beginning of the financial crisis. We are probably, and I speak with a bit of trepidation because there will be a meeting later on today where each and every word will be very attentively scrutinized, but we are probably approaching the point where, for the first time since 2006, the United States will raise short-term interest rates, and they are likely to do that later this year. Do not please ask me in the course of the question whether it will be in June or whether it will be in September. I've been asked that question. I've already said I don't know, which somebody said, oh, she's probably saying September. No, I'm not. But clearly this country, given the way where it is in its recovery process and the very specific indicators that it is analyzing with great scrutiny, that country is probably going to start the process of normalizing its monetary policy, which has been anything but normal because it was unconventional and because it was navigating in very uncharted water in the last few years. And even if this process is well managed, the likely volatility in financial markets as a result of the process could give rise to potential stability risks. So let us consider today the risks of such monetary policy spillovers. I will not look into the spillbacks, which is something that is, this sort of spillover or the spillovers, if you will, which is obviously going to be of concern to those monetary authorities that have to decide upon what they do and how they do it, given that their scope of immediate concern under their mandate is typically of a domestic nature, but where spillbacks can have a sort of second-rank effect. I think it's best to begin that discussion by placing it into the context of current global development and the risks that the world economy is facing, because this is clearly something that we are in a position of analyzing and exploring on a global basis. I've said that in Delhi yesterday, and I'm saying it again in Mumbai. We see the global growth, and there is global growth, as still fragile, uneven. And despite a boost to global growth that has been the result of the decline in oil prices, we now expect the world economy to grow by about 3.5% in 2015 and 3.7% in 2016, which is still growth, let's face it, and it is actually the average growth that the global economy has known for the last 10 years prior to the financial crisis, but still it is surprisingly low for a period of post-deep financial crisis as we have seen it in 2007 and 2008 and subsequent years in particular. Now why do I say that it's uneven? Well, clearly the outlook differs significantly across country and across regions, and we can no longer speak of the group of the advanced economies, the group of the emerging market economies, the group of the developing countries, because within each of these three groups we see great diversity. In the advanced economies, we are certainly seeing growth rebounding both in the United States and in the UK, although maybe not to the same extent and with the same impetus as we had about 6 months ago, but it is still expected to remain above trend in the near term. It's strengthening, but gradually. By contrast, the euro area and Japan, in their domestic demand, especially credit to private sector and investment, has yet to recover fully. And while we are seeing some indication, some signal, some indices that are heading in a better direction, it is not still growing at a pace that is at potential. In emerging markets and developing countries, growth is projected to pick up from less than 4.5% this year to a little more next year, but again, it will vary from country to country significantly. And that 4.5%, by the way, is a little bit below what could have been expected and certainly below the average that we have seen in the past few years. Among the emerging market economies, as I've said yesterday and was reported, we see India as a bright spot. And while there is no doubt that it has had the benefit of oil price declines in many different ways, there has also been a consequence of significant policy decisions, policy announcements, and hopefully policy implementation that will sustain that rebound of confidence that we have observed concerning India. And hopefully India will reap the benefits of good policies and those good policies implementation. My meetings yesterday with Prime Minister Modi and Finance Minister Jaitley have left me strongly convinced that the new government is skillfully shifting the focus to good macroeconomic management, clean, efficient and more transparent government, as well as inclusive development, including inclusive finance. And this seems to have raised business confidence and hopes for all levels of Indian society. It is also borne by the latest GDP statistics, new generation, if I may add, and my personal hope is that there will be a good reconciliation between the inevitable political timing of reforms and policies and the inevitable high expectations and sense of urgency that the business sector, let alone the media, have about the sort of immediate effect and consequences of such reforms. On that global economy, we still see many challenges, of which two are particularly relevant for India. The first one is the recent strengthening of the US dollar that has resulted from the relatively strong US recovery combined with the divergence of monetary policy paths in advanced economies. And this has put pressure on countries whose exchange rate regimes are linked to the dollar but yet conduct a substantial share of their external trade in other currencies, as well as on sovereigns and corporates that have borrowed in foreign currency heavily, notably in US dollars. So as I said, it is putting pressure on the balance sheets of those sovereigns, corporates or households that borrow in dollars but that have assets or earnings in other currencies. India's corporate sector, which has borrowed heavily in foreign currency, is not immune to this vulnerability. Corporate sector debt has risen rapidly, nearly doubling in the last 5 years to about $120 billion. The second challenge that we see as relevant to India, and that is really the main theme of what I would like to talk about after that, is the prospective normalization of monetary policy in the United States and its spillovers to emerging markets. The risk of financial market and capital flow volatility along with sudden increases of interest rate spreads, remain a real possibility as US interest rates will begin to rise. So let us look at this particular topic in some details. UMP, I will call it that way, unconventional monetary policies, stands for UMP in our funny IMF language and jargon. It's also the name of the political party that I used to belong to when I was Spanish. So it's always quite funny for me to talk about UMP. So including, you know what UMP is about, I don't need to describe it for you, but it has been used to provide policy accommodation in advanced economies since 2007, beginning of the financial crisis in the summer. And these policies have had both positive and negative spillovers. Unconventional monetary policies helped avoid a financial market meltdown in the initial stages of the crisis, and later supported a recovery in advanced economies and elsewhere. And I'm convinced, the IMF is convinced, and I don't think that there would be many to actually dissent with that and argue that at the very beginning it was an absolute necessity and it helped avert a 1930s style global depression. And to that extent, UMPs have had strong positive spillovers for the global economy and by implication for emerging market economies and for India as well. I know we have a little bit of a debate as to, later on whether it was as efficient, but at least to begin with, there's little doubt that it was necessary. But it is, and we certainly acknowledge that, it is also true that these policies led to a build-up of risks in this part of the world. Between 2009 and the end of 2012, emerging markets received about $4.5 trillion of gross capital inflows, representing roughly 1/2 of global capital flows. And such inflows were concentrated in a group of large countries, including India, which received about $470 billion of capital flows. As a consequence of that, bond and equity prices rallied and currencies strengthened. Recent work by us suggests that spillovers to asset prices and capital flows in emerging market economies from expansionary UMPs were even greater than from earlier conventional policies. The danger is that vulnerabilities that built up during a period of very accommodative monetary policy, just as quickly as it built up, can unwind suddenly when such policy is reversed, creating as a result significant market volatility. Now, we already, all of us, had a little taste of that when the taper tantrum episode broke out in May and June 2013, when most emerging market economies suffered indiscriminate capital outflows, India included. And I'm afraid that this may not be a one-off episode. And this is so because the timing of interest rate lift-off and the pace of subsequent rate increases can still surprise markets. Now, this is an issue that is debated. Some argue that markets have priced this in, that it's anticipated, that there is good communication policies. We believe that depending on volume, pace, timing, it can still be a surprise. As economic conditions improve in at least some advanced economies, portfolio rebalancing out of the emerging market economies can be expected, and some volatility cannot be ruled out. So, emerging markets need to prepare for that volatility risk and this uncertainty. So what are the lessons? What can we learn from what's happened? And actually the rapid distinctions that markets made between the emerging markets back in May, June 2013. Just a few of them. First of all, and probably foremost, advanced economies can help. Clear and effective communication of policy intentions can reduce the risk of creating very large market volatility. And while admittedly it is a difficult task, I would also agree that there is scope for greater international policy cooperation to minimize the negative spillovers. Now, why do I say cooperation so carefully? Because there is a bit of a debate between colleagues as to how deep that dialogue should be. Should it be by way of coordination? That's a bit of a heavy word. So the accepted principle is that there has to be, and there is, cooperation, but our view is that there could probably be greater international cooperation. So that's as far as the advanced economies are concerned. While dialogue is a two-way street, we believe that the onus is on the advanced economies. Second, emerging markets need to prepare well in advance. Evidence from the research work that we're doing at the moment suggests that emerging markets that had already addressed their economic vulnerabilities before the taper tantrum in 2013 fared better during episodes of market volatility. In particular, those countries with higher GDP growth, stronger external current account positions, lower inflation, and more liquid financial markets, all of that helped dampen market volatility. In addition, more resilient financial sectors contain the effect of such volatility. And the reforms that have been initiated here in India are going in the right direction, are very timely, but will also need to be pursued with utmost speed. Third lesson, if market volatility materializes, central banks need to be ready to act. Temporary, but aggressive monetary policy may be necessary, particularly in the area of domestic liquidity support to certain sectors or certain markets, along with eventually targeted foreign exchange intervention. In addition to that, we also believe that cross-country central bank foreign currency swap lines that have proven helpful in due course might also be helpful in the current situation. There are a few examples of some of those effective fundamentals and swift responses that we have seen. Korea is certainly one that comes to mind, which improved the resilience of its financial sector with measures that reduced bank short-term external debt by half to 20% between 2008 and 2013. Other countries such as Brazil, Uruguay, and Indonesia used some form of capital flow management measures to discourage short-term inflows of capital. Peru intervened directly, although temporarily, in the foreign exchange market to limit excessive volatility. So you have a whole range of different tools that were used, more or less successfully, depending on what fundamentals the economy presented itself with. And here in India, the RBI took decisive action during and after the taper tantrum episode. It provided foreign currency liquidity, support to key sectors, allowed the rupee to depreciate, and provided judicious foreign exchange interventions to minimize disruptive movements in the rupee. The RBI also arrested the surge in gold imports, narrowed its current account deficit sharply, and started to rebuild foreign exchange reserves. I think I've covered all the tools that you've used, and to great success. So in a very short time frame, India successfully contained its domestic and external vulnerabilities more than in many other emerging economies. Does that mean that work is done? Recipes has been tried? We're all set and ready to face any storm? More needs to be done, as usual. Apart from short-term policy responses to deal with acute economic crisis, we believe that it is equally important to build a safe and inclusive financial system that serves well in good times in supporting broad-based growth and provide an effective buffer in bad times in ensuring financial stability. But there are questions about the extent and speed with which financial development should be pursued. The experience of advanced economies has shown the dangers that can arise from oversized financial systems. Our Our economists at the IMF have done some work on rethinking financial development and its implications for stability and growth in emerging markets. This work is still being finalized, will be published shortly, probably next month, just at about the time when we have our spring meeting, which is a nice occurrence. But I would like to share with you a few encouraging findings from the work that has been conducted. First, there are many benefits still to be reaped from further financial development in most emerging markets, including India. And by financial development, I mean depth and efficiency of institutions and markets, as well as a higher access of all citizens to banks and financial instruments. The RBI has taken several encouraging steps by allowing for a greater role for the private sector in India's public sector banks. There will undoubtedly be a striking increase in efficiency in the banking sector. And this is not to say that the public sector is inefficient, but this good breeding and sort of cross-fertilization is certainly an efficient way to bring best practices to bear in order to improve the productivity and the good risk management of those institutions. Moreover, Prime Minister Modi's commitment to broadening access to formal finance to all segments of the population through the ambitious Jan Dhan Yojan, now I hope pronunciation is okay, is impressive, and the speed at which that has been implemented is quite extraordinary by all standards. The second lesson, and related findings from the IMF, is that when it comes to financial deepening, there are speed limits. When done too fast, deepening financial institutions can lead to more instability, both economic and financial. It encourages greater risk-taking and high leverage, particularly when poorly regulated and supervised. And this is not me saying here that this particular country is poorly regulated and poorly supervised. Not at all. This is not my point, far from it. But it puts a premium on developing good institutions and regulatory frameworks and having the ability to scale them up once the financial sector is deepened and eventually broadened, and takes a different form. We were talking earlier on about the role played by technologies, and I remember as finance minister for my country the sort of rivalry that can develop sometimes between different regulators, when you have a telecom regulator on the one hand and a prudential regulator on the other one, and their views do not necessarily reconcile, and there is not necessarily enough of a cooperation and a bridge between the two, so that the player who is in the middle and subject to both can actually either find itself at odds with different regulatory environments and in a complex situation. Now, India's record in promoting good practices has been very positive in recent times. It is making progress toward addressing bad loans in public sector banks and in developing a sound regulatory and supervisory regime for banks, insurance and securities market. Best international practices are being adopted, sometimes a lot faster than competitors or colleagues abroad, and it's really quite remarkable to see that Basel III ratios, for instance, and criteria are being implemented, have been implemented actually earlier in India than in many other countries. The government's recent announcement to introduce legislation on a new Indian financial code, which will simplify and revamp India's financial regulatory architecture, is also a revolutionary step. Third finding of the IMF study relates to potential trade-offs of financial regulations. One view is that tighter and more regulations will help safeguard financial stability, but it will hamper financial development. As former finance minister, I've heard that so many times. You know, don't invent new regulations. Our inventivity, our inventiveness, our creativity, our ability to create interesting, exciting new products is going to be hampered. Well, our new IMF study, to be published next month, as I said, finds that among a large number of regulatory principles, there is a small subset that is truly critical for financial development as well as for financial stability, and that's the interesting finding. Some examples include regulations related to capital buffers, non-performing loans, financial disclosures, and compensation. And it actually matters for both financial development and financial stability. So it's not as if they were mutually exclusive. If well observed and implemented, they are conducive to both innovation and stability. And there is no conflict as a result between promoting financial stability and financial development if you choose to focus on those key indicators, these key regulations that will help. So on this note, I was supposed to be brief and I've been way too long, I'm afraid. I'm just fascinated by the vibrance, by the spirit of reform, the entrepreneurship that seems to have seized many institutional levels, including at government level. And both on the economic, on the financial, on the fiscal, on the tax front, I'm very excited by what is happening in this country, and I look forward to coming shortly. Actually, we will be coming back next March with a big regional international conference that will be co-sponsored by the Finance Ministry and the IMF in Delhi for 3 days, which I hope you will be attending, and which will harness the competence and the skills of many, many talents in the region and outside the region. So with that, let me again thank you very much for your hospitality, and be available for your questions or any questions you'd care to ask. Thank you.
Thank you very much for that wonderful tour du monde. And, my duty here is first to start off with some questions. And, I'm a central banker to one country, you're the central banker to the world in some sense. How do you sleep at night? Well, let me put the question this way. What are the big risks you think face us around the world over the next year? What are the things that we're not fully prepared for? I would ask you unknown unknowns, but by definition we don't know what they are. But what are at least the known unknowns that you worry about?
Well, excluding the known unknown, which is that sort of multitude of black swans that can land on us any time. I would say that the first one, in terms of both chronology and ability to spread, is the one that we talked about, which is this asynchronous monetary policy, where we see the Fed reverting to traditional monetary policy and the spillover effects that it can have, while at the same time the Bank of England is continuing its process, although at a stabilized pace, and the Bank of Japan and now the European Central Bank are either continuing or entering the sphere of unconventional monetary policy. And that asynchronicity is, as we said, going to have volatility effects, both in terms of financial markets, in terms of foreign currencies, in terms of interest rates. And because it is, as you know and you've written about this, as those are very much unknown policies, and as everybody is in uncharted territories, the combination of the withdrawal on the one hand, the coming into the same world of unconventional monetary policy by the others, is something that will have significant effects. And I was in Africa not long ago. Things that we don't necessarily think about. Small countries having recently issued on the international bond market. Some had decided to go dollars, others had decided to go euros. Well, the consequences on, both are going to be of a completely different nature depending on the way things go. And if you combine the sort of low commodity prices that we're seeing around the world because of the low that I will mention in a second, together with the exchange rate variations and the financing cost that will probably rise in some corners of the world, it's going to put some of those countries in a very difficult position. The second risk that I see is that I call the low, high. Low, high is low inflation, low growth, high unemployment, high indebtedness, which affects predominantly the Eurozone area and a few other countries, which could have this sort of recessionary and deflationary effects, which would be very counterproductive when it comes to both growth creation, job creations, and will have consequences for what is still on a global basis the first, if not the second, economic area of the world. The third one is it's not an economic risk, but it could certainly have economic consequences, and that's the geopolitical risk that we see, which creates massive uncertainty, dampens the appetite to invest, to expand, to increase trade. And I'm thinking clearly of what has happened for the last year now at the border between Ukraine and Russia, what is happening in this arc between Afghanistan and all the way down to Mali, with a very insidious and horrifying threat, which sometimes has ramification completely outside that area, as unfortunately this city has experienced a few years back. So I would say that this is the third one.
We've seen in the last few months the rise, or probably over the last few years, the rise of populist parties, certainly in Europe, but to some extent in the Americas also. And a common theme seems to be anti-immigrant, anti-trade in some of these parties. How important do you think is this sort of backlash against globalization? Is it going to go very far? Do you think there are forces which will essentially mitigate these concerns? How do you see this going forward?
It's absolutely right that in quite a few countries we see the rise of populism, sometimes nationalism, sometimes driven by national history, geography, sometimes religion, and that it is not without consequences on trade, on the movement of capital flows, on the movement of people. And it is a fact also that for the last 20 years or so we have seen trade as a significant agent to reduce poverty, to increase growth, to open up sectors of activities, sometimes sectors of our brain that were closed and locked up. And I think that the more we explain how trade, opening, tolerance, respect applied in economic terms has been beneficial to the global economy, I think the more, I hope, people will appreciate that this is a way to go, as long as it is not excessive, not abusive, and doesn't leave people behind. I would certainly hope from an economic point of view that we can have a combination of continued trade and globalization, while at the same time developing projects that you are working on, such as inclusive finance, such as implementation of reforms that are the consequences of the work that we are doing concerning the relation between sustainability of growth and reduction of excessive inequalities, because then you present the two faces of the same phenomenon, where growth is actually activated by those general global movements, and yet it is tempered or rather made more palatable for all as a result of financial inclusion and sustainability, which cannot happen without reduced excessive inequality. But if I may add, I think that multilateralism as a principle of addressing global issues is also one of the attributes of this landscape that I have in my mind. And on that page I have to say that India is a great supporter of multilateralism, and I hope will continue doing so.
Well, I think we've tried to make it abundantly clear that India benefits from an open global economy. We are dependent on trade, on buying in a lot of inputs, and therefore our security, in some sense, our economic security, is dependent on the global system being open and free. And therefore we have a big stake in it, and we have a big stake in the success of institutions like the IMF. But on that, I mean, let me ask you a last question, which is, you talked about unconventional monetary policy, and I have a small issue that I wanted to ask you there, which is, I mean, clearly you talked about the early stages of unconventional policy as being beneficial, perhaps in repairing markets, perhaps in creating a new sort of optimism in the economy and so on, and we've seen various versions of that play out. The question, and of course, we also understand that it creates some risks as a result of the cross-border capital flows, and we in India have experienced those flows. We also are trying to manage them, and of course, can never say that we've got everything under control, but I think we're far better than where we were. But the one question that remains is, what if these policies get extended over time, and what if the primary sort of impact is on exchange rates rather than on domestic demand? Would that be a source of concern for the IMF? Would that be something the IMF would start raising questions about? Or is it something that's okay?
I think it is, well, first of all, these unconventional monetary policies, based on at least the conventional wisdom of those who comment about it or those who implement them, are not policies that are supposed to last forever. They are of a temporary nature, and they were clearly intended by all those who articulated their vision about unconventional monetary policies to deal with particular, specific issues under particular circumstances. Output gap, low inflation, slack in the labor markets were all attributes of those unconventional monetary policy, and the ability to sort of manage those were I think, high on the mind of those central bankers. So that's number one. But taking your hypotheticals, which I hope is not to materialize because of the temporary nature of those policies, I think yes, we should be looking at the consequences in terms of exchange of exchange currencies and the effect it has on those. Yeah, we should.
Well, I've monopolized you too long. Let me go to the audience here and see if there are questions. Sonam?
Hi, ma'am. Two questions actually. One, the low regime that you've talked about, I think IMF has been talking about relatively easy monetary policy, growth supportive fiscal policy and structural reforms. The first two sort of arrows have been used in a sense by the developed economies, but growth is no better than it was 5-6 years back. So what are we missing in terms of policy?
That's the third one. The third one clearly.
Just in terms of anything specific on structural reforms that the IMF has in mind. Second, you mentioned there isn't enough cooperation. So assuming that the beggar thy neighbor policies continue, how does the IMF see it playing out, and what is the end game?
Okay. To your first question, you mentioned 3 key attributes.
Yes.
Monetary policy easing, number 1.
Correct.
Number 2, growth-friendly fiscal policies. And third, structural reforms. Monetary policy easing has taken place for the last almost 7 years now in the United States, and is now coming to an end with probably tightening to return. fiscal consolidation, whether they liked it, wanted it or not, has in fact taken place. Structural reforms, more or less, but that's probably not where it was most needed. What are we seeing? A significant pickup in growth and results that are not bad in terms of employment and employment participation as well as unemployment rates. So I think we have to, there's one thing that we're learning at the moment, is that each and every country is a story of its own, and that we cannot put all advanced economies into one basket, all emerging market economies into one basket. India, compare it with Russia, with Brazil, South Africa, with China, different story. Different set of circumstances, different performance. The same goes with those policies that you've just talked about. The easing of monetary policy by the European Central Bank has been excellent description of what it would be. Some instruments which have been used, including the litros on 2 consecutive sequences, but effective purchasing by the ECB, that is just about, that has begun exactly a few weeks ago. So I don't think that we can argue that this has taken place, there is no result. It is beginning. In terms of growth-friendly fiscal measures, they have not always been very growth-friendly from some of those countries. And as far as structural reforms are concerned, there is still a long way to go by many of the largest players in that part of the world. So I think the jury is out as to whether or not the combination of the 3 actually works. But I would observe that if the 2 are generally sort of short-term consequences, the third one, which can have short-term consequences depending on the nature of the reforms, but are more likely to have medium-term consequences. So I think, again, time management is something that needs to come into play in that whole picture. You second about the cooperation. I didn't say that there was not enough, because I think that there is solid cooperation, but I'm not the one to measure and time the cooperation between central bankers, because I'm not one. Keynes would have liked the IMF to be a central banker, but this didn't happen by virtue of whatever they agreed in 1944. But, Mr. Governor, you could certainly speak to a point of significant inflection. They can and there should be more, so that communication is well done, cooperation is solid and frequent, so that there can be good anticipation, good preparation by those who will be suffering or at least receiving the spillover effects.
On that issue, I think one of the concerns that central bankers across the world have is that they've done too much. And global cooperation requires yet more actions. And so my sense is the appetite for global cooperation is smaller than one might wish, but it may emerge very strongly conditional on the events happening. So it's, you might want anticipation, but anticipation is very difficult when the issues seem far off, and already central bankers have done a lot which is raising political concerns within their countries. Therefore, it may take actual volatility in the markets to bring forth the cooperation. We hope that when push comes to shove, cooperation will emerge. As you know, just this week we announced a swap arrangement with Sri Lanka, which will create some protection in case markets turn volatile. Sajid?
Good evening, Mr. Lagarde. In the most recent update in January, we had a situation where U.S. growth was marked up and growth of every other economy was marked down. And this is a more general narrative that growth in the U.S. is going to remain strong and the rest of the world is in a much weaker cyclical position. My question is, how sustainable is this equilibrium, given the cross-currency implications, a much stronger dollar that could choke off U.S. growth? And if that threatens the stability of this equilibrium, where do you think the balance of risks lie? Is it of a U.S. economy powering along, given domestic demand, which lifts global growth and causes a convergence of monetary policy? Or is it one where you've got depressed global growth, weak China, for example, and that in a way forces the U.S. to postpone any tightening cycle. Where among those in that spectrum do you currently see the balance of risks?
Oh, I wish I knew that response, but I don't. Certainly what we see with a recent significant appreciation of the dollar relative to quite a few other currencies with which the United States is trading and has investment links and financial relationship, it's very likely that the economic numbers and the growth numbers of the United States will, be affected by that significant appreciation, and so will probably the numbers of economies that have seen their currencies appreciating as a result, and I'm thinking here clearly of the Eurozone in particular. So I wouldn't regard those sort of numbers as static, given the currency movement that we are seeing, and given the consequences, the granular consequences of the oil price decline that we have observed also for the last 9 months now. Slightly reduced now given the most recent development. But there will be consequences. And where the equilibrium will settle, I always have in the back of my mind that the emerging and developing market economies represent more than 50% of the global economy. And although the United States constitutes still the largest economy in the world, by virtue of the fact that it is one country as opposed to, say, the Eurozone, which is 18 countries, and other regional strong trading activities, I think that there will be equilibrium which will not be powered by one single engine that will be the United States of America. And I would not bet on what is regarded as a decline of Chinese growth. And it's not because China goes from around 7.5 to around 7 that it is in decline. It is still an economy which, by virtue of the base at which it is growing at 7%, is still growing very strongly and leading the pace, as India is.
Sugar?
Thank you. Ma'am, I have just 2 questions. One was partly what Sajid asked was, are you worried about only the one-way movement of USD and its repercussions? Second was, in terms of US growth, is there any risk factor in terms of a lot of investment having gone into energy sector as well as labor market participation in that sector?
Ooh, that's a pretty pointed question. On your first point, the recent appreciation of the US dollars, I think my sort of apprehension about a significant and rapid appreciation of that nature is tempered by the fact that the US in and of itself is a relatively closed economy, and the repercussions to other economies is actually more by virtue of the fact that the dollar is this international currency of reserve, and that a lot of trading is taking place between other players in US, and it's denominated in US dollars. But I think the effects are of 2 different natures. I think I would have to be an oil and power expert to address your second question. I'm not sure that I'm that person. I don't even know how to answer the question as to how long the oil will be at the price where it is at the moment. Is it going to stay at 56, 57? Or is it going to, raise to 60-ish, 70 low in the next 12 to 18 months? And if so, what will be the level of capex by those power companies and oil companies? I think it's more likely to decline at the moment, but it's a highly cyclical activity, and the moment the prices rebound again, yet some of the investment will be justified again. And I think we have to look at the energy sector in a broad way and not focus on oil and gas, and have in mind those investments, capital expenditures that are also being made in the renewable energy sector, which are very often a factor of where the oil prices settles. And clearly the higher the more, they will be in that category too.
That was a great answer. It reminded me of my MBA students answering tough questions in consulting interviews. How you create the framework to give the answer. Let's have somebody from the press, Lata.
you for telling me.
Oh, sorry. Well, ma'am, we are celebrating what, the second anniversary of the taper tantrum in 8 weeks. Do you think it will still disrupt markets, or is it largely discounted as and when the hike happens? So, are we really, should we really worry about that as the biggest threat for financial markets? Is it more likely that the threats will be elsewhere in 2015? For instance, could the ongoing spat between Greece and Germany evolve into, once again, exit fears or exit threats at least? Or will the threats to financial markets come from something else altogether, debt default by some commodity countries?
I think in a way I've addressed your questions both in my speech and in question by your governor, but I'm happy to repeat myself. Taper tantrum caught us all by surprise, and I think that it helped a lot of economies, a lot of central banks to actually prepare for that. We understood quite quickly the distinctions that were made by the investors between those economies that were solid, where growth was sustainable. I took the extreme case of Korea, which was well prepared and had strong fundamentals on the one hand, and there were others, weaker economies in those days that did not take the right measures very promptly and that were much more affected. So I think that has been a good lesson for all of us, to prepare, to strengthen the economies, to be able to use the currency variation, to use reserves eventually. There's a whole toolbox that was created as a result of that taper tantrum, and a methodology as to how and when it should be used. So I think that if it is not priced in by markets already, which I would doubt, at least some of it is bound to have been priced in, because the President of the Fed has already given signals, and I think there is more uncertainty around when it's going to happen and by how much, rather than if it will happen, which to me would say that any normal investor worth his salt would have priced in some of it. But as I said, there will be volatility. We went through a period of total lack of volatility for very long. Some people got used to it, but the normal way of operating is more volatility than no volatility. Well, more volatility than what we had, than no volatility. As to the other questions you had, it's part of the geopolitical risks that I mentioned, and what happens within a currency zone is a matter of discipline amongst the members, the rules that they apply to each other, that they decide to respect, whether they want to operate transfer or not, whether structural reforms are implemented or not. And this is very largely a matter of political determination by the players themselves. I think yet again, markets are not stupid, and they have priced in certainly a portion of potential risks that could be on the horizon.
Thank you. We have a Prachi Mishra who's come to us from the IMF.
So there are three of us, huh?
So, Ms. Lagarde, I was just wondering, if you have a sense of what the net spillover effects are from normalization of, monetary policy in the United States, for example. So, of course, normalization comes along with, U.S. economy becoming stronger. So that's positive. And, of course, the negative is the effect on volatility. How do the two, how do you see the two of them comparing? How does it vary across countries? Are there certain emerging markets, for which one effect is more likely to be, larger than the other? So just wondering what your sense is on these net effects.
I don't have that result. What we have done I don't have it because we don't sort of publish scenario planning of that nature. But we have studied very extensively and measured the spillover effects of the QE1, QE2, QE3, if I recall, and tried to measure which countries were most affected, by how much, what was the spillback as well from those countries in terms of consequences on the US economy. I would just caution us on one thing. we just assume that there will be spillover effects, if only because a lot of the capital inflows that went to these emerging market economies that provided higher yields than anywhere else would actually outflow back to the safe haven territory where there would be higher interest, and particularly higher long-term interests. Well, remains to be seen whether that is going to actually work. Because you move on the short term, is that going to immediately have consequential effects on the longer term? To be seen. We've seen, you know, a bit of, I forgot how it was called, the Greenspan conundrum. Well, let's hope we don't see that, but we might. So there are a few, you know, question marks and uncertainties around the necessary link between the two, and as a result, the consequences that it will have on the capital outflows producing those spillover effects that you referred to.
I think given the overwhelming number of questions from the ladies, let me go to Gent. Ajit, you get the last question. I think
that is a very good sign of inclusion, and I hope that India continues to demonstrate strongly that necessary inclusion.
Thank you, Governor. Madam, you head the IMF, and this is India. So this is an inevitable question, so pardon me for asking it. It's been 5 years since the quota reform was approved, and there's one country which has been dragging it for 5 years, so the quota reform is still not in place. My question is, have we lost anything because of the delay? If not, then the quota reform is just symbolic, all sound and fury, for signifying nothing. So we should, you know, so what's the IMF's position? I know it's putting you on a spot, but it's been so many years, and if the quota reform is irrelevant, why are we pining for it?
Okay. It's not irrelevant, and you have no idea how personally frustrated and irritated I am about this lack of delivery and implementation of what was intended in the first place, especially when everybody else has decided to implement. You know, it has a double impact. The first impact is that instead of being predominantly quota-based in our financials, we are quota-based, partly, and relying on the goodwill of a good portion of the membership to lend to the IMF, either under those new arrangement to borrows for those that are in the know, or on the basis of bilateral agreements that were signed subsequently. So what I'm saying here is that I think we have enough resources. As soon as I took my job, I went out to get additional bilateral loans because I thought that we needed more funding available just in case crisis happened or developed. But it's not the right structure of financials. And some of it is potentially at risk, whereas the quota base gives it certainty, solidity, that was desired by the initial founders, and that is desired by the entire membership. So that's one. So funding is okay, we have the financials, but I wish it was structured. We don't have it because it is upon the other one happening, which is the governance reform, which provides for and less representation by the Europeans, who are very many at the table, not including the chair. And a stronger voice by way of voting rights, if you will, which is assimilated to quota but takes a different form. And on that particular front, there is no delivery, which doesn't trigger the quota increase. The fact that there is not the adequate representation around the table, I don't think stops us from doing the business we have to do, stops the management and staff to...
All right, that was Christine Lagarde, the chief of IMF, in conversation with the RBI governor, Dr. Rajan, talking on a whole host of things. We heard her talk about the global economy, the outlook there, Indian economy, and really on what she feels about India as far as the world is looking at India to lead the path to higher sustainable and inclusive growth, and a lot of other things about the challenges that the Indian banks are facing. In fact, we have some news now coming.